Go.
Streaming from South Africa to the world. This is the Stonks Go Moon podcast. What just happened? We break it down so you don't have to.
Welcome everyone to the Stonks Go Moon podcast. My guest today, Marc Blinder. He is the founder of AIKON.
Hey, nice to meet you all.
Welcome to the pod. Dude, I love your hair. That's an iconic look in itself.
I know, and it's people can't see the podcast, but I've got some.
That is the way to direct them to the YouTube, my friend.
Get on the YouTube.
Listen, for the listeners that might not know, you do strategy for OR as well, the Open Rights Exchange. What exactly is that all about? Yeah,
well, thanks for asking. So the OR network, and if people want to learn more, it's or.network is the website. So OR network is a blockchain that's got a very narrow use case. It's designed just to hold identities for people that connect to cross-chain wallets. And again, that could be a little technical, but for folks not in the blockchain space, you have all these different NFTs, all these different cryptocurrencies. They're all in different blockchains.
Yes.
So we wanted to do something that would actually be convenient for a consumer.
Yes, because people think when you say blockchain, there is one blockchain. There are multiple. Let's just put it out there. There are multiple blockchains, people. So this is essentially like grouping them all together, I guess.
Yeah, well, I mean, we are adding chains as fast as we can. So right now, the OR ID, the OR login connects to 7 different blockchains, but we're always adding more. And, obviously the most famous ones are ones like Ethereum. Maybe people have heard of Polygon or Avalanche, if they're in the kind of trading space. But, there's more. There's hundreds that have been created. And obviously, to use a blockchain, you need a wallet.
Yes.
And the average person probably doesn't even care about having one wallet, let alone having one wallet for every blockchain that they might ever use in the future. Like, who needs that? So basically,
equivalent to having 100 credit cards, right? I mean, it's just ridiculous.
Yeah. And so the OR ID is a kind of identity standard that basically connects Web 2.0 logins that people are used to, like log in with Google, log in with Facebook, log in with your email address. Yes. We take a login like that people are familiar with, and we connect it to wallets on multiple blockchains in the cloud. So it's seamless for the user. You just, as a person, you're just like, oh, I hit login with Google and now I'm using this app and I'm getting NFTs or I'm paying for something in crypto.
Because as the more user-friendly blockchain becomes, the easier the adoption will be. And I guess that's what is holding a lot of people back, especially in Africa, which is like, I mean, the growth here, especially in cities like Cape Town in South Africa, is massive. It's like introducing people to blockchain through the technologies that they are familiar with. Like you said, I hit Google Authenticate or whatever, and it remembers me, and it's an easy process. So what you're saying to me makes sense.
Yeah, because exactly. People have these very lofty ambitions for this blockchain revolution, cryptocurrency revolution, right?
Yeah.
There's this ethos that we're going to have a, people-powered global money that anyone can use anywhere in the world. But the flaw in the system today is anyone can use it if they are very technically savvy with computers, if they understand private key, public key encryption. So what we're trying to do is say, hey, we think this vision is amazing. We want this dream to become a reality. And so we're going to help by making it easy for the masses, make it very approachable for the average person.
What year did you guys start?
So we started late in 2017.
So that's quite early, right? So what would you say? Well, I mean, but my question being, from 2017 up until now, what's been sort of the biggest change that you've seen, or what's been the biggest shift?
Yeah, so like when we started in 2017, it was like the peak of the ICO boom, and there was a lot of blockchain's going to revolutionize everything, right? It's like there's going to be a blockchain knockoff of Uber. There's a blockchain Airbnb. We're going to have a blockchain, Target and a blockchain Walmart, right? And I think what has come over the last 5 years is we've started to see, due to a combination of regulators, like governments coming in and trying to force certain rules, market adoption, user experience, all these different things. We've seen a few use cases really emerge, like DeFi, NFTs, that are really consistently make sense, have millions of users, and real value. And so I think there's been this big change from this just huge stage of dreaming and creativity and everything is going to work. And I think we'll get there. Actually, I do think we may have a blockchain-based competitor to Uber, but that's going to be 15 years from now. First, we need to get
but it's refreshing to hear someone speak about not pie in the sky stuff, but then laying down realistic timeframes to say, guys, this isn't going to be next week. This isn't going to be next month. This is decade stuff, remember? Because we're talking about replacing legacy technology with something completely different. It takes time.
Yeah. Oh, absolutely. I mean, look at how long it took from the launch of the internet until we had Amazon shipping us toilet paper, right? Those decades. And blockchain is going to be the same, probably faster because technology has increased its pace so much, but we're still talking about a 10, 20 year effort to get some of this stuff. And I know this is a trading podcast. And so it's one of my pieces of advice to people, I'm not a trader professionally, I'm a startup founder, right? But I always say to people, if there's something you believe in the blockchain space, don't try and day trade it. Just stick with something that you believe in for a couple of years.
Yes.
And that's when you're going to have your biggest chance of success, right? Market's super volatile, goes up and down crazy day to day, but 5 years, it's way up.
But now that you spoke about trading, thank you for giving me my segue, because segues are in a very short podcast, very hard to come by. I want to talk about that article you did in Fosway, and I love the way that you sort of related crypto back to the 2008 financial crash, if I can call it crash, correction, if I look at where we are now. And there were 3 sort of main lessons that you highlighted there. Would you mind sort of taking us through them? Starting with, I think, algorithmic stablecoins. You say algorithmic stablecoins aren't possible.
Yeah. So, I mean, that's my belief. I mean, you can never prove something's impossible, but, I think it's one of those things. So I guess first, let's step backwards 1 second. So we were talking about the 2008 financial crash, Lehman Brothers, right?
Yes.
The Bitcoin white paper, Satoshi Nakamoto's white paper, came out months after that, hot on the heels, right? So there was this obvious awareness that the existing financial system was not built to serve people. Right. And it was built to, obviously it's very effective. It's great, especially if you're in rich countries, it works very well. But if you're in developing nations, it's often extracts value away from developing nations. And if you're, lower on the socioeconomic ladder, even in a rich nation, it's not really your friend. Right.
And central bankers do not give a fuck. They do not care.
Well, and even I mean, you look at the U.S. Federal Reserve, their mission is to keep inflation in a certain band, right? It's not to help you afford a house. And we could argue about whether that's good or not, but that's what they care about, right?
Yes.
And so, and the Wall Street banks exist to make money, right? And so what we saw with the financial crash is that when they had a chance to make money by putting some very complicated math in front of mortgage-backed securities that people didn't really understand, and they were able to make a huge amount of money by making something look stable and safe that wasn't actually stable and safe.
Yes.
And that's always been my fear with algorithmic stablecoins is you're taking a basket of assets like a bunch of houses that got packaged up into mortgage-backed securities. You're taking a bunch of cryptocurrencies, and it seems diversified, but in reality, they all correlate together, right? So when like Bitcoin and Ethereum go down, DAI goes down, Solana goes down, Polygon goes down. Like they all go down at the same time usually. And so what you have then is this thing that's giving the illusion of stability and often is stable for many years. But then when the dam breaks, it breaks really hard, right? Like what we saw with Terra Luna and their stable coin, quote unquote, which vanished into nothing overnight. It's like it's stable, and then it vanishes just like Lehman Brothers, right? Because you had this basket of houses that seems diversified, but in reality, you've just packaged up a bunch of things that are kind of the same.
Yes.
And so,
But that's what we call the great financial experiment, right? Is because we have this hypothesis, but we don't know. And I guess we'll only find out as we go along.
Yeah, we'll try. Well, and that's why, I mean, so to me, I like to play it a little bit safe with this kind of thing, just because I'm not really a believer in the algo stablecoins. So like my belief is you're better off with the dollar-backed reserves, right? So like the USDC, that's at AIKON when we do business in stablecoins, which we do all the time, both getting paid and paying employees and contractors and stuff like that. When we do it, we only use USDC really.
Okay.
And it's because they've got audited books where they have $1 sitting in a bank account for each USDC that exists. To me, I don't understand why an algorithmic stablecoin would be any better than that for a member of the public. And yet it's much riskier. So like, it's not in an obvious way better, but it is obviously riskier, as we've seen with some of these unfortunate outcomes.
Let's leave it there before we get into trouble. I think let's move on to the use of non-custodial wallets. So, okay, first of all, in layman's terms, for people that might not be familiar, what is, I'm not going to say wallet. If you don't know what a wallet is, then there's no hope really. What is a non-custodial wallet?
Yeah, so again, this was part of the original design of cryptocurrency and blockchains, right? So part of the original design is that it's self-sovereign. So as a person, you are in control of your own assets. So you're looking at, again, in the wake of this financial crisis, people who had their money with Lehman Brothers, with Morgan, with Bear Stearns, right? They may have lost all their money because they weren't actually holding their money. They'd given their money to the bank. The bank had invested it. And then when the bank goes bankrupt, depending on who you were, you may have lost everything.
Yeah.
And so we just saw this happen again with Celsius, right? The bank went bankrupt and it looked like a non-custodial wallet. So people thought they were in control of their crypto, but they weren't. They just had a record at Celsius that Celsius owes you 10 ETH. And so when Celsius goes out of business, you're screwed.
Yes.
So, but the difference at the heart of it is a non-custodial wallet basically means you are holding your own assets. So Marc Blinder has an Ethereum wallet with such and such a public key, or an Algorand wallet or whatever.
Yes.
I control those assets. And so
that's where that's where the saying comes from, not your wallet, not your assets.
Yes. Yeah, exactly.
Okay.
And so that's one of the things we've invested a lot in technology-wise at AIKON is making ORID a non-custodial solution so that a consumer doesn't have to, I mean, like, hey, I'm running a startup. It's a risky business. Like, we're in business, but again, like you saw Celsius, multi-billion-dollar company, and all of a sudden 2, 3, 4 bad decisions, they're out of business and everyone's money is trapped.
Okay, so here's my question. Sorry to interrupt you. I'm just with Celsius, what would their incentive be to make it look like a non-custodial wallet and it not being one?
Well, I think they're, and again, I'm sure they had very sophisticated lawyers and marketing, so I'm sure there wasn't an obvious lie in the marketing, but it looked like a wallet and looks like you're holding crypto. And there's a belief in the market that crypto is safe from these kind of problems because it's built to be non-custodial and self-sovereign. So there's this idea that, oh, well, if I have my money in an investment app or something, I might get locked out of it. But if I have cryptocurrency, I can't get locked out of it, right? No one is in charge that can lock me out.
Yes.
And so it lets you, I mean, basically it looked like the way Celsius was set up, and I was a Celsius user. So, we'll get to my personal story with that in a second, but like the way Celsius was set up is it looked like I was lending my ETH to someone and they were paying some interest. In reality, it was actually operating more like a hedge fund. So they were able to pay me really good interest because they were investing and making all these risky bets with my crypto. Now, there are other products out there like Compound, like Aave, where you can lend and it's non-custodial. So you can always get your ETH back.
Yes.
Because it's a smart contract, it's sitting on the blockchain, no one's in control. So they made it kind of visually look like that. Look like they're paying you interest to lend your stuff, but in fact, they're paying you interest because they're running a hedge fund with your money. And then when they made a couple of bad bets, everyone gets wiped out. And I have to say, so like I was a Celsius user, but I'm like in the industry, right?
Yes.
And so I was hearing whispers. And one of the things I actually really feel guilty about and regret, I pulled 95% of my money out of Celsius like a week and a half before they busted and stole everyone's cash. And I was halfway to tweeting about what I was hearing and just didn't do it because I was like, I don't actually know anything. These are just rumors.
Legal ramifications as well.
Legal ramifications,
Because if that isn't true, or that turns out and they sue you, then you become liable. If you don't, I mean, it's a tricky and complicated scenario. Let's take the ethical situation out. If you just look at the legal side, I would have probably done the same.
Yeah, and because I didn't have any concrete information, right? It's just, and so that's why I'm trying to be a little more outspoken now for people to help people make smart decisions with their own investment, because I do think people have a chance to make money in cryptocurrencies, in blockchain investing, in tokens, and I want them to have a chance at that, but not get wrecked along the way.
Which, I love it, wrecked. Brings me to the last point that you made. It's leverage and margin trading are for professionals only, and it echoes something that I've been a proponent for a long time. It's that you do not trade crypto with leverage. If you find someone that tells you to do that, you have my permission to shoot them in the face.
I couldn't agree more with you, because it's just, crypto is so volatile. And the thing about margin or leverage, right? Basically, the way leverage works is, your listeners probably know, but for anyone out there who doesn't, right? Like basically you're taking, if you have 10-to-1 leverage, 10 times the risk. So all you need is your investment to go down 10% and you're bankrupt. It's all gone. Right. And so that's one of those things where we see with crypto, especially when it's going up and everyone thinks it's great, there's a lot of incentive for people, or a perceived incentive for people to like take those riskier bets. But if you aren't a major professional, like you're risking a lot.
But even they get wiped out, because the Nasdaq will go down like 1 or 2%, and Bitcoin will go like 15%. How you know what I mean? It's like, how do you compensate for that? You can't.
Yeah, you absolutely can't. And the reason the professionals do it is because they're betting other people's money. They're getting paid to take all these bets, and if they're wrong, maybe they lose their job or something, but like they aren't going to be out on the streets, and you are. If you're an individual that's leverage betting on Bitcoin, or it's just a really tough thing for even very smart amateurs. It's a really difficult thing.
Mark, thank you so much for joining me. Just before I let you leave, there was an article this week about, and I'm not sure if I'm pronouncing it correctly because I was actually not familiar with the protocol. Bitgert, is that right?
Yeah, I've never met them, so I don't know how they pronounce it, but
let's just go with that.
Yeah.
But there's an article, and sometimes you don't know if something is PR or if it's just like smart marketing. But they were talking about the threat that it holds for other protocols like Solana and Cardano and the likes. Just talking about the pace at which they are developing, and the fact that the platform has almost zero gas fees, which, I mean, you just hear everyone complaining all the time about gas fees. There is this whole hope, I guess, of the Ethereum merge that gas fees are going to come down. What is your take sort of on, first of all, Bitgert, I guess, in terms of the threat? And then my second question would be just like sort of the disruption of other blockchain protocols.
Yeah, so I think we've seen a lot of major projects that have very low gas fees, right? So like at AIKON, we work with Polygon, we work with Algorand, we're about to launch Avalanche integration next week. All of those have gas fees that are pennies, right? Not dollars or tens of dollars like you might end up paying on Ethereum. And so I do think that's where the market's going to go. Like most transactions, you really can't afford that. And frankly, we work with Telos. I mean, they have zero gas fees for transactions on Telos. So there's a lot of projects out there that have that promise, either very cheap or zero like transaction fee. So I think that is a threat to folks like Cardano or Ethereum. And we've seen tons of growth on these new upcomers. Mm-hmm. Someone like Bitgert is so small that like I doubt anyone at Cardano's even really heard of them, right? Because they're so small. But I do think just as a trend, there's a huge demand from the public for lower gas fees. And there's a lot of projects trying to solve that problem.
But if there's a lot of projects, then zero gas fees aren't really going to become a differentiating factor, am I right? Because then it's just like the industry standard. What would these platforms need to do then to differentiate themselves from the other competitors?
Well, and this is part of why it was so important for ORID to support multiple different blockchains, because I think the truth is with most software, you have to specialize and be good at certain things, right? So you may have some things like Hedera that can do just an amazing amount of transactions per second.
Yes.
So for certain use cases, like really big supply chains, you need it. But like no one really cares that much about the gas fees. They're in that for the transactions per second. With Ethereum, it is the most decentralized smart contract platform. So it's like, it's truly uncensorable and it's like the most trustworthy. So if you are going to move $1 billion, do it on Ethereum, right? Like if you're going to go move $1 billion, pay the $50 gas fee, do that on Ethereum, please. Right. But if you are just doing day-to-day transacting, then someone like Polygon or Binance Smart Chain, where the transaction fees are very low, but it's still pretty decentralized, then you've got like probably a happy medium for a lot of people. And so I think there's not one answer, right? Yes. They're going to differentiate in different ways and be good at different things. And that's just the way software works.
Yeah, good answer. Marc, thank you so much for joining me today. If the listeners want to go and connect with you and find out more about AIKON, where can they do that?
Yeah, AIKON is AIKON.com and OR is ORE.network, or.network. And yeah, all of Twitter, Telegram, it's all on there.
And go and follow Marc on LinkedIn as well. Marc, thank you so much for joining me today. To our listeners, peace, love, and prosperity. I'll catch you in the next one.